All right. I think we're live there. Yeah, and we are just waiting for some people to join. So let me go ahead and just give it a few minutes. I'll probably just give it a minute or two while we wait to see if anyone shows up. There's a couple people. I'm sure we'll have. Okay, it's going live on several different social media channels, so that's good. I'm just going to let this kind of keep playing out here. Um, get some more people in the room before I get started. Let's see. I probably should wait about 3 or 4 minutes. Let's see what we got. Thank you all for anybody that's already there. I'm not sure, as far as chatting goes, you can't chat on Twitter yet. You can't chat on most social media. It's crazy. It makes no sense because that's the whole reason you're going live is so that you can chat with people. So this really doesn't make a whole heck of a lot of sense. Um, you can obviously see why you're here. So, as I am a 2.5 decade long, or a little, I guess I was a little shy of 2 decades as kind of an official financial advisor in the business. I've worked with I don't know, 1,000 clients. I don't know what the number would be, but I ran a very different type of business than most financial advisors do. I kept my client base somewhere around 75 clients at a time. I felt that was the only way for me to actually know about them, who they were, to take the proper active interest in who they were, and to serve, like to give them proper service outside of the, hey, come into the office. I'm going to show you, a lot of shiny stuff. I'm going to do a financial plan and a portfolio review. That's really plug and play. We'll probably do it once. You'll transfer your assets over. Then I collect a fee each year on those assets for investments that someone else manages. So there's going to be some fees outside of that. I didn't really run a business like that. Now, I will tell you that doesn't mean you need to be angry at anyone that does run their business like that, because the fact of the matter is that is the way that particular system is designed. So it's not designed to benefit an advisor if he learns how to invest your money, if he learns how to trade better, if he learns how to identify bull markets, bear markets. He doesn't benefit from learning those things. Where the benefit lies in the traditional financial advisor relationship, and I'm not saying all financial advisors do this, but where the benefit lies for a financial advisor is in bringing in new assets, more clients. Because I mean, just think this through for yourself. So you're a financial advisor and you're bringing in, even if it's $1 million client, you bring it like liquid. He gives you $1 million, it's liquid. 5 million, it's liquid. It doesn't matter what the number is. The story will still make sense. If he brings in $1 million and it's liquid, and he spends, thousands of hours mastering the market, thousands of hours learning how it moves, why it moves, the adjustments that he or she can make for you, and he's getting you an extra 10% a year on your money. That's amazing for you. You're making $100,000 a year more, right? 10% of $1 million is $100,000 more. So you're making you're making quite a bit of money more. But to him, and you have to look at this from a selfish standpoint, to him, if he's making 1% on your assets, he made you $100,000. That means he made an extra $1,000 that year. So is his time, these thousands of hours that he spends, is it better spent figuring out how to make you an additional 10%? Or is it better spent finding another $1 million account, which then pays him $10,000 a year? I don't think that's very hard to figure out. That's very easy math to do, right? So that's the way that system is set up. And what I saw a lot of people do, and what I still see a lot of people do nowadays, is They hire a financial advisor, whether it's in a major firm or a bank, it really doesn't matter. If he's an independent or whomever he works for, they hire him and they just fully they give their money to this guy. They never ask any questions. They never learn anything about their finances. And let me tell you why that is a huge mistake. Let me tell you exactly why it's a huge mistake. In fact, I'll give you a really recent story. So, I don't always just talk about financial planning, right? So, I spent my life learning how to invest money. That was what I enjoyed doing. I liked the investment aspect of it, right? I always set someone up with a financial plan. I always made it an actionable, workable financial plan that we reviewed at least twice a year, right? At least twice a year. Really, that's probably all anybody actually needs. So I did do that. But where my interest lied was in investments. And so as you do something for 25 years, the way that I have, you learn more and more and more and more, and you get better and better and better at whatever you're passionate about. For me, it was investments. I can tell you that, and so I'm online all the time. And what I do for active investors and active traders is I help them. They're already good at what they do. Most of these guys are very good in up markets. They know how to make money. They understand what they're doing, and they're quite good at what they're doing. What a lot of traders and investors are not good at is the trend change. They don't know how to evaluate when you're getting to a top or when you're getting to a bottom, and then they don't scale in and out properly. So they lack a lot of structure and discipline. So I spend a lot of time showing people that, hey, I know how to identify tops and bottoms. I will show you how to scale in and out. I'm not telling anybody that I'm going to make them 100% a month or 100% a year or whatever wild numbers fly around out there. I help a lot of investors and traders that are already very good get much better by creating a very disciplined walk it with them, creating a very disciplined strategy that they follow, based on the three pillars, as I see it, of investing, which is cash management, risk management, and investment management. So those three pillars are what I view as a necessity if you're managing investments. So back to my story. I'm online. It's October of 2022. And I can tell you that I came on the day that they announced the invasion of Russia into Ukraine. And I told everybody that this was the bottom and that we're here we go, right? Here we go. And as it happens to be, I actually nailed the day. I'm never in the business of nailing the day. I could be a month away, right? The price action is what I follow, because that date, that's the one thing that's very, very hard to nail down in finance. I can tell you when it's toppy, when you should be pulling out of a market, when you should be covering your positions. I can tell you all that, but it might take another month to get there. It might take another 2 months to get there. That's how real money is made in the stock market or the Bitcoin, the crypto market. That's how real money is made there too. Most of the best guys in the business, their real talent is staying out. They stay liquid until a real opportunity presents itself. They get involved, and then they're liquid again. And then when a real opportunity, presents itself, they're involved again. I mean, that is how the best in the business do it, right? So on October 22nd, on October 2022, I'm telling everybody, here we go. It's time to go. I can't tell you how many remarks I got about how foolish that was. I don't understand economics. We're going to war. Oh, you think because we're going to war that means that, we're going to have, like, it's going to create abundance. And it really had nothing to do with the fact that that war was announced, and absolutely nothing to do with the fact that that war was announced. It showed, I could see very clearly that we were in the late stages of that bear market, and that at any time it was going to rally. And it just so happened that on that particular day that it did. Now, let's move on to one more example, and then I'm going to get to the point here on why I'm not always talking about financial planning, why I'm not always talking about education in finance. So, like, having a proper financial plan. I'm not always talking about that, but why am I talking about it today? So here's another example. It's August, what was it? It was the 5th, 4th, 3rd, 2nd. It's August 2nd of this year, 2024. And I effectively had called a price target that we hit on August 2nd. That was Friday, as the low of the bear market. Well, lo and behold, Monday, everybody walks in and the NASDAQ is gapped down 5.5%. the S&P is gapped down like 3.5 or 3.75%, and the Dow is gapped down 2.5%, right? Huge gaps down. Now, something that people that work with me on the investment side learn is that gaps down in bear markets, especially as you're approaching the end of a bear market, are used for one thing: incite that last level of fear, that last gut punch to investors, because most people will quit at that gut punch. They won't be able to handle it. And that's precisely what August 5th was. August 5th was the bottom. From there, it just went straight up. Now, we can argue that those big gap downs, those are big gap downs, don't get me wrong. But on August 5th, when everybody was screaming and yelling about the invasion of Ukraine and the war's coming and we're in so much trouble, I was telling everybody, and you can go verify this if you like, that this is not 2008. This is not 2009. You should be buying. This will be the bottom, so on and so forth. And we had hit my price target for the bottom on Friday, but then we got that last wall up on the 5th of August this year. And then it took off. Now, here's the point. So why do I talk about having a proper financial plan, and then that financial plan as an essential piece of what you're doing as a person? So you can be focused on the investments. Look, I'm focused on the investments. I love the investments. But let me tell you something. Without the financial plan, the investments are going to go awry. And here's why. The reason that the biggest mistake made by people is that sometimes we think things are so complicated, or we're led to believe that they're so stressful, that we don't educate ourselves about them. We don't learn about them. We can't, we just don't want to be involved. Because this is why I believe a financial plan is so important, and why learning from someone is so important. So on those 2 days, I'm sure I wasn't the only guy that knew that that was the bottom. I'm sure I'm not the only guy on the planet that has the ability to identify areas of weakness, right? So topping patterns, and then areas of actual strength, which is, if you look at price, that sounds contrary. Your areas of weakness are high prices. Your areas of strength are low prices. Most people reverse that. They flip that in their mind and they get it all wrong. And this happens over and over and over with them. Because on those 2 days, if you could just blindly trust me, if you were just listening to me and you had that, yeah, right, everybody would have been buying. But that's not the response I got. I was told that I didn't know what I was doing. I thought that war was going to create something. Listen, October of 2022 and August 5th of 2024 are hardly related, in the sense that they were the bottom of a correction, except for the fact that they were the bottom of a correction. One was a big correction, one was a small correction. So the reason I tell people that they must have a financial plan is because it begins to educate you. When you walk through and you do a financial plan, you dissect your life financially, right? So you go in, you say, okay, how much money do I make? How much have I saved? How much can I invest? How much can I save? What are my plans for the future? When would I like to buy a home? How much do I think I need to start to retire? How much is education going to cost me when it comes to the kids? And some of these variables you're not going to know. But what you are going to do is you're going to start exploring your life. You're going to start establishing a budget. Okay. You'll establish that budget. And then the next thing, hopefully, that you do is you go in and you take a look at asset allocation and what that means. How does asset allocation work? Why is this the prevailing knowledge in investing today? So why is the prevailing knowledge that, hey, we have all these different asset classes, you should own some of each of them, and then you'll kind of ride the middle. So in down years, you're going to be down, but not as much as other positions. And in up years, you'll be up, but not as much as other positions. Why is that prevailing wisdom exist? How does it actually protect you? And I'm going to get into that today in this conversation as well. But so the reason I tell people to learn about those things is because then you start to be able to identify the frauds. It's really for you. This education is for you. Setting up a financial plan, learning about asset allocation, learning how to place a trade, or how to set up an account, or what account to set up, right? Like, is it an IRA, a Roth IRA, a SEP IRA, a 401k? Like, what should you be even setting up? Learning that stuff translates you into building confidence. And when you're online and someone like me is talking, you start to go skip, 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 skip. Oh, there's somebody who knows something. Skip, skip, skip. You should educate yourself on the biggest things in your life. You should educate yourself on your health, your physical health. You should educate yourself on your wealth, your finances. These are the two most impactful things that will ever happen to you that you can do something about. So you can do preventative care when it comes to your health and your wealth. You can do preventative care. This is why I'm so big on having a financial plan, creating a financial plan, and one that really matters, which brings me to something that I am doing right now, which is I am offering my Invest Like a Pro course at a 95% discount from now through, here, let me get that up. There we go. Now through Tuesday at midnight. Okay, so from now until Tuesday at midnight, or until 1,000 of these courses are sold, whichever comes first. If I sell 1,000 courses before Tuesday at midnight, then it's done. If Tuesday at midnight comes first, that's perfect as well. It's my Invest Like a Pro course. Let me tell you what it is. So it is 7.5 hours of video tutorial, me talking with you just like this. You're not going to walk through a slideshow with a voiceover, right? I am going to walk you through step by step. You're going to have all the software necessary to create a financial plan based on Monte Carlo simulation. If you're not familiar with what Monte Carlo simulation is, it's a simulation that was created for the stock market. So we know the average performance of a stock market, but we also know that stock markets go up and they go down. And, stock markets, they don't just go one direction, they go many directions. And so what you have to do is you have to scramble up. You have to scramble up those returns, and it'll give you a probability analysis of your success. So it'll walk you through the financial planning. It'll teach you about asset allocation. It'll teach you how to set up an account. I'll teach you about the different retirement vehicles. So like IRA, Roth IRA, SEP IRA, 401k. Where should money go first? What should you do? How to place a trade, the history of Wall Street and why it was created. And then, what is it now? And I'm selling this course. I typically sell this course at $500. I'm right now selling this course at a 95% discount at $23 because I don't want there to be any reason that someone can say they don't have a proper financial plan put in place. This financial plan is the same financial plan. It's the same financial planning that any financial advisor or broker at any major firm would do for you. I am walking through the same steps. I worked at Merrill Lynch. I worked at Wells Fargo Advisors. I ran my own shop for a decade. I know exactly what you're getting. You will get nothing less than that out of this course. And let me tell you something else. There's an added benefit. You get to keep this and you can do it over and over. So you want to readjust every 6 months, by all means do it. And you should do it. And the reason that it's so cheap, again, and I say cheap, this is cheap. This is the most inexpensive thing. This is 25 years of knowledge. I can't tell you how many hours I spent creating this. I made it this is inexpensive for you so that you could improve your situation. Because as we were just talking about, I came out in October of 2022 and I told everybody this was the bottom. But if you don't have the confidence to believe me, if you can't say, hey, that is correct, I can see where that came from. I can see how he came up with that. If on August 2nd, which led into August 5th, obviously, I say, hey, this is not like 2008. This is not like 2009. You should be a buyer right now. But you don't have the confidence in what I'm saying is meaningless. That's why I believe in education so strongly. I'm going to take this down now. There's no reason to look at that the entire time we talk. But that's why I'm such a big believer in education, because I can give you all the answers. And having done this for 25 years and having done this for 1,000 clients, looking over 1,000 different lifetimes, financial lifetimes, and just lifetimes in general, events that took place throughout people's lifetimes. Having done that, I'm fairly certain I can identify very quickly any mistakes someone's making. But that person has to have the confidence in me to realize that what I'm saying is true. So you out there as the investing public, if you haven't educated yourself, what's going to happen is this. And I saw a lot of this back in 2008 and 2009. What is going to happen is this. You can have a financial advisor and you can trust him and whatever. But when we get into a truly hairy market, and even the what I think the S&P fell somewhere between 25 and 30% from 2001 into 2000 and or 2021 and 2022. I think it fell somewhere between 25 and 30%. I'm sure that many of you out there hit the eject button on some of your investments, whether it was crypto, whether it was stocks, whatever it was. I'm sure you did. And when you called your advisor, he's not going to give you a ton of pushback because, as we talked about 5 minutes ago, he does not benefit from that. He does not benefit from your anxiety. He does not benefit from your fear. Okay. He might benefit some from your greed, but he's not going to benefit from those other two emotions. So if you want out, he's going to pull you out. And let me tell you something. I lived through 2008 and 2009. Do you know how many people were bailing at the bottom? Nearly everybody. Nearly everybody. There were very few of us that knew what was going on and knew how to read what was going on, so we could evaluate with a calm mind what to do next. And this is what learning about finance, your finance, you will do for you. Because that brings me to my second point. I think one of the most important things about finance, people talk about their financial lives and all the time, especially nowadays in social media, it's all about, getting wealthy, being a baller, having this, having that. They try to show flashy cars, helicopters, jets, whatever they're trying to show. For the average person, this stuff isn't going to happen. All right. You just have to know that from the outset. But let me tell you what will happen to you and what I've seen happen many, many, many times over when it comes to finances. People suffer mental health issues from it. One of the most stressful things in the world is money. Plain and simple. Why is money so stressful? Well, first off, it's by design. We just have to be honest with that. Money by design is going to create stress because you have to have money to do certain things. Okay. So when you don't have money, when you're running out of money, like let's just say, so we're going to ignore investing right now. We're going to ignore, financial planning right now. If you don't have much money and you get sick, how much trouble are you in? A lot. If you don't have money and rent's due, how much trouble are you in? If you don't have money and you need groceries, how much trouble are you in? A lack of money, all in itself, is a heart squeezing, horrifying situation. Now, I want you to think about a group of people right now. That group of people are people that retired 2005, 2006, 2007. They worked their whole lives, saved their whole lives, put in their 401ks, their pensions, the 401(b)(3)s, their IRAs, their SEP IRAs, their self-directed 401ks. They're putting money in there their entire lives. All of a sudden, 2008 hits, and they watch this thing that they built their entire life fall in half. How much just fall by 30%? How about you work for 40 years, let's say 45 years, because it'll be easier math. You work for 45 years saving up every day for retirement. It's 2007. You have your retirement party. You get I don't know, what are maybe a big giant luxury RV or something to travel to see grandkids. I'm not at that age yet, but you do whatever retirees do and you're excited, right? And then 1 year later, you look at your account and 35% of your money is gone. 15 years of savings is gone. It took you 45 years to get there. It took you 1 year to knock 15 years worth of your savings off the table. How afraid are you? How terrified are you? Because you're not seeing money as like, oh, that's 35% of my retirement money. It's really easy when you're young. You just go, oh, well, I'll sit through it. No, you won't. I promise. I've watched this time and time again as a financial advisor. You won't. You won't unless you're educated and you made intelligent decisions and you've done intelligent things so that you're not just getting hammered in retirement. Okay. So if that money's disappearing, believe me when I tell you, think about it. What if it was a $2 million account? Just what if? All right. That means about $700,000 in 1 year was gone. If you think your account's going to fall $400,000 and you're going to sit there, I have news for you. You're not. That is why I always say that buy and hope is a bad investment strategy. It's a very bad investment strategy, if I'm being honest. Okay. But first, the first building block of life is asset allocation. It's understanding asset classes. It's understanding that they move differently in different markets. It's understanding that sometimes this asset class literally will be the number one asset class in the following year. It'll be at the bottom. I'll give you an interesting point. If you took a look at Tesla just as a stock, this isn't even an asset class, this is just a company. In 2021 in December, that would have been the most popular stock on 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 the internet, 100% on the internet. That would have been that A was one of the most popular stocks with big institutional money managers, retail traders. Everybody loved Tesla. How do you think it looked 2022 when it was down 70%? You think everybody was hyped up about it? No. Guess what it's done since 2022? So it fell 70%. That's a big number. It's rallied almost 100% since 2022. But here's the thing. So up here, when everybody loved it, that's when you should have hated it. Down here, when everyone hated it for dropping, that's when you should have loved it. Let me explain to you how a proper financial plan will do that for your investments. Because one of the big things that I'm doing here is I'm trying to explain to you that when you have a financial plan, it can protect you from some of your bad behaviors. Now, this is what I mean. So everyone's in love with Tesla and they're buying it. Then it falls 70%. Now everyone hates Tesla. No one's buying it and it's up 100%. This is exactly backwards, right? Exactly backwards. And anybody who's been investing over a long period of time can tell you that that backwards thing happens a lot. So let's talk about how a financial plan helps you to avoid that scenario. You set up this financial plan. All right. You say, I'm going to go into a growth plan. So you have, or actually, let's just say balanced because it's easier to work with. So a balanced portfolio, for those of you that don't know it, it just means like you're half stocks, you're half bonds. So let's explain how this works. Most people are going to rebalance their portfolio. If you do a set it and forget it portfolio, you're still going to rebalance twice a year. Every 6 months, you rebalance it. So let's just say that you have these stocks, these bonds 50-50, and stocks go on this crazy rally just through the roof. Like stocks are just going straight up. Okay. Now your stock portfolio is 70% of what you own and your bonds are 30 because guess why? Stocks and bonds tend to work inversely of each other. They tend to. It doesn't mean they always do, but as a general statement, bonds do well when stocks do poor and vice versa. So now you're 70% stocks and you're 30% bonds. You come up for your 6-month rebalancing. It shows up. Well, guess what? You're going to have to shave off 20% of what you own in your stock and you're going to buy into bonds. And guess what you're doing? Your stocks were high flying. You are now selling at the high. Your bonds are falling and you're now buying at a low. So if you remember, as we were just talking about with Tesla, most people were really fired up about Tesla in 2021. And then by 2022, they were absolutely depressed because it had fallen 70%. And you can guess how many of those people bailed out of Tesla because as stocks fall, as sectors fall, as industries fall, and as indexes fall, excuses will come out of the woodwork. But if you have a portfolio set up for you that's based on some methodology, right? If it's an asset allocation methodology, and let's just say bonds go gangbusters, right? Bonds right now are really, really low. Okay, they're very, very low priced, and it looks like a lot of money's pouring into them. So I would expect bonds to be rallying here, and then that should probably inversely affect the stock market. I mean, I think right now what people are thinking is that we're going to have some sort of hyperinflationary environment because of what interest rates have done. This conversation isn't exactly appropriate for what I'm doing here today, but I think people right now are thinking we're going to head into this hyperinflationary environment. And if we do head into a hyperinflationary environment, there's nothing better to own than stocks. That's what you want to own. And you'd want to own Bitcoin and you'd want to own gold. You'd want to own all assets, right? And then bonds you probably would want to steer clear of. If you don't know, as interest rates rise, bond prices fall. But I have to tell you, if you look at the bond market right now, It doesn't tell you that people are getting out of bonds. It tells you that people are getting into bonds. I wouldn't expect that hyperinflationary environment. Therefore, right now, just from an economic standpoint, you can say to yourself, okay, well, the stock market is weak. Even though it's at high prices, everyone, it's weak. Whereas the bond market is at low prices, but it's strong. Counterintuitive, right? So this is the way that a financial plan can guide your investments. And guess what else? When you set up a financial plan, like I said to you, it's going to go through a Monte Carlo simulation. You're going to want that simulation to be probably 80 to 85% probability of success. That's where you're going to want it to be. Because to me, that just feels, I don't know, that feels comfortable to me. It feels like that has a very high degree of success with it, right? So the reason that you're going to, the reason you're going to feel comfortable, how that can make you feel comfortable is if you then are saving every month the way you wrote. So whatever your financial plan says, hey, I'm going to save X amount every month. I'm investing it here, so on and so forth. As long as you're following that and you're looking at that, markets will, so say a market starts to pull down just into your standard correction of 10%. I can tell you that there are some people that will begin to panic. But if you're pulling up your financial plan and it says, you'd say you're in growth, okay, you're in growth right now. You're pulling up your financial plan and it says that right now you still have an 83% probability of success based on your financial plan. You know that there's not much maneuver to make. However, if it drops down to say, let's say 78% probability of success, which makes you uncomfortable, you do not like that. It has a 78% chance of success, and you go, I don't like that. That's no good. What you're going to do is you're going to start playing with numbers. The first thing you'll probably do is you'll take a look at your budget. Hey, can I save more? You'll look at that. The next thing you're going to do is you're going to say, okay, right now I'm in this growth portfolio. What's a balanced portfolio do for me? What does a high risk portfolio do for me? What does a conservative portfolio do for me? You'll start playing with that. And believe it or not, it can help you to guide your investments, right? Because, so for example, if the stock market's pulling down really hard, but the bond market tends to be doing well, your financial plan may say, take some risk off the table. That might be the answer. It might just be save X amount more a month if you can. Like there's all sorts of variables that are going to play in here. And so let me throw up my little commercial again, because I am right now offering a 95% discount on my Invest Like a Pro financial planning course. It is 7.5 hours of video tutorials with me talking to you just like this, walking you through step by step everything you need to know, from you don't know anything about financial planning to you have the same financial planning knowledge and financial plan as someone that works at Wells Fargo, Merrill Lynch, Bank of America, wherever. Okay, now you have the same knowledge that they have, and you've put together the same thing they have. And I have news for you: if you think that that's a challenging thing, if you think that that's something that can't be done, I could teach today's sixth grade, today's sixth grader, I could teach them how to do this inside of probably 2 hours. All right. I have a 7.5 hour course with video tutorials, a 70-page workbook, all the software you need to do this, budgeting worksheets. It will take you through the history of Wall Street, why and how it was created. It will take you through setting up your own personalized financial plan. Then you'll walk through what account might make sense for you. So it's an IRA, a Roth IRA, a trust account, a custodial account, a joint account, a 403b account if you're a teacher or somebody that works nonprofit. It'll walk you through that. Then it'll walk you through how do you set up an account at a discount brokerage such as E-Trade or Ameritrade or anything like that. How do you place a trade? How do you set up rebalancing? Then where and how should you have your money invested? So it'll walk you through the basics of asset allocation and how to choose your model. And believe it or not, choosing your investment model, whether you're going to one of the major firms on Wall Street or whether you're doing it from your living room, is done the same way. You're effectively taking your age minus 100, and that's the percentage of bonds you should have. So, like, if you're 70 years old, you go 100 minus 70 is 30. You should be 30% bonds. 100 minus 60, you should have 40% bonds. and so on and so forth. It really is that simple. That's really how you choose. But I don't actually believe that. And I don't actually agree with that. What I think you do as you're setting up the financial plan is you get in there and you play with those models a little bit, right? So if I add a little money here, what does that do? If I change up my risk profile, my investments, what does that do? Okay. But what I can tell you and what I can guarantee this will do for you is it will, in fact, build confidence. You will have a confidence within yourself that you understand finances, that it's not going to feel stressful to you. I can tell you, I've watched people literally have like near mental breakdowns over their financial situation because they just didn't know anything about it. They thought it was so complex because, listen, let's face it, that's what you're told every single day, right? This is too complex for you. You don't want to do this. Let me tell you something. When I started in this field 25 years ago, I started with a small regional firm, AG Edwards, and I walked in. I didn't know what an IRA was when I came in there. I had no idea what it was. I thought that was the investment. No joke. I thought that was the investment. An IRA was an investment. I didn't know it was like a retirement account. Okay. I studied for my Series 7, so that took 2 months. I got, my state licenses, that took another couple of weeks. By the 3rd month I was there, I could meet you, and the truth was, with what that firm wanted me to do, which was basically just choosing you an asset allocation model, what the firm wanted me to do, I could meet you and know exactly what I was gonna do with you. And pretty much everything else I did was just a show. Everything else was just a show so that you felt comfortable with me and you felt confident in what I was doing. But the fact of the matter is, I was 23 years old. I learned how to do it. It did not take me 2 months. It did not take me 2.5 months. It probably took me 3 days. And I could be a full on financial advisor. And by the way, I was recruited by Merrill Lynch less than a year later. That's how successful I was at what I did. And then I went on to learn about investing. And that's something that I do. That's something that I do. It's something that I absolutely love, which is educating people on how to set up a proper investment plan based on the 3 pillars of investing, which is cash management, risk management, and investment management. That's not what this course is on. This course is to set you up for your life. Listen, everybody wants to move to the sexy stuff. How do I increase return? How do I do this? What's sector rotation? Without a financial plan like the one that I have right here built for you, that has 7.5 hours of video tutorials, a 70-page workbook, and everything you need to set yourself up. Without this, you'll make mistakes. Let me explain, actually. I just brought up an interesting point. I said sector rotation. I wish I could chat with you guys on here. I don't like this. I work through Restream, and for some reason, I can't chat. Here, let me pull this course down. By the way, click on the QR code, coupon code PRO96. This is only going to last until Tuesday at midnight, or I sell 1,000 courses, period. Once that happens, I'm done. Then I'm going to shut this down. I sell these courses at $500 all day long. But right now, I'm doing it for $23 because I don't want anyone to have an excuse as to why they don't have something like this. And I'm going to be online quite a bit talking about it because this is something I believe in and I'm passionate in, and I know how many people make these mistakes. So let me talk with you about sector rotation. So everybody likes the sexy stuff when it comes to how to invest. And the funniest thing that I see online right now, and I have to tell you, I don't know that I would call it a mistake, but one of the funnier things that I see online is that everyone is always talking about futures or options, and they're telling you how much money they make. And I have to tell you, it's almost laughable. It's almost laughable. Not because I can tell you definitively that they're lying, but I can tell you this. In 25 years, when someone told me about their finances and the decisions they made within, now there's a crypto market, but then it was just the stock market, the bond market, the commodities market, and currencies. In 25 years and looking over thousands of different portfolios, I can tell you that there was only one time that someone was honest with me about their performance and how they manage their money. One time. 99.9% of the time I was lied to, knowing they were going to have to show me their statements. Now, that's real life. That's 25 years of my life. Now, if someone knows They're going to have to show me their statements, and I'm going to know that they've lied. What do you think the likelihood is that someone online that is never going to show you anything except for some fake live screen, what they can do as far as performance? And I know what a 20-year-old with a $5,000 account can do as far as performance. He can give that $5,000 over to Wall Street inside of a month, probably inside of a week. He'll be chasing losses so fast he won't know what to do. And that's not a dig, that's a fact. Okay. So let's go back to how a financial plan protects you and protects your investments. I want you to know. So sector rotation, I was just talking about it. So what sectors are? Sectors are just areas of the market. Everybody kind of knows what sectors are. Like everyone's heard of energy, technology, consumer staples, consumer discretionary, utilities, industrials, materials. So your sectors. So a sector rotation, effectively what it does is you just say, okay, so I'm going to own a piece of every single sector. I want to own. So maybe you do even in equal parts. You say, look, I actually know I'm not good enough to do this. I know I'm not good enough to choose my investments and get it right. I know I'm going to get it wrong. So here's what I'm going to do. And this is a way to improve performance and reduce risk without knowing very much, as long as you're using a proper financial plan that institutes an asset allocation model that follows your sector rotation. Now, this is what I mean by that. So you own an equal piece of every sector in the S&P 500, okay? Let's just, for argument's sake, that the energy sector and the technology sector, let's just say that they go gangbusters for 2 years. Whoa, okay? And then you have at the bottom, your industrials and your utilities are doing horribly, all right? You're invested in every sector in the S&P. Everything else is moderate, aside from energy and technology, which has gone gangbusters, and then industrials and utilities, which has really just dropped off a cliff. Just dropped off a cliff. As we were talking about earlier, most people are going to rebalance their investment portfolios at least twice a year, so every 6 months. So guess what happens? Every 6 months in your sector rotation investment, you're pulling some out of technology and you're pulling some out of, what did I say, energy. So technology and energy, you're taking some out. And then in your industrials and your utilities, you're putting some in. Guess what you're doing? You're selling high and you're buying low. Now, I can promise you, if you go through, there's like this Ibbotson chart of like asset allocation. If any of you have a financial advisor or you've investigated one, I know you've seen it. It has a bunch of different colors, and then it'll say like large cap growth, large cap value, large cap, and in bonds and corporate bonds, and it has all the asset classes listed. How many times do you see the leaders in the market become the absolute laggards in the market on that chart? I can tell you it's all the time. That's the answer. Now, this shouldn't be the end of your mission. This financial plan, this asset allocation model, this shouldn't be the end of your financial education. This should be the beginning. But I have just shown you how using a financial plan and using an asset allocation model attached to that financial plan can actually protect your investments and improve your performance. This is why I say this is the foundation of everything that I do. Because once you understand that, then it is time to start really digging into the investments. And this is what I mean by that. So if you're over here on the investment side and you're really, like you're doing really well, everything's going amazing, but you have no financial plan, you're liable to make the same mistakes I've seen a million times over. You spend too much, you invest in things you don't know, you start investing kind of haphazardly because you're making so much money over here. But let me tell you what I see in markets all the time. You're going to have great times, probably amazing times once you get good with investments. But there's also going to be times that things just don't make sense to you, and it doesn't mean you're getting killed, but you're not doing well. And if you spent too much, invested too much, you didn't save enough, all of a sudden, this financial plan, your actual life, your finances in life begin to suffer. Guess what you're going to have to start doing? You're going to start to have to forcibly sell your investments to pay your bills, no matter where the market is and no matter what opportunity might be over there. It's not going to matter because when it comes down to paying rent or feeding yourself, you are going to do that long before you are going to keep pumping money into an investment. So, again, if this is off, if this is wrong, it is always going to hurt the investment side. Okay. However, if this is right, if you start here and this is correct, then it can guide the investments. So you can never go wrong by getting this right. And let me put this up again. This is why I am passionate about having a financial plan. And this is also why I took hours upon hours putting this together. This is 25 years worth of knowledge. This is 7 hours, 7.5 hours of video tutorial with a 70-page workbook that walks you through the history of Wall Street, how to set up a financial plan based on Monte Carlo, walks you through every step, what accounts are appropriate for you, in what order should you put money into those accounts, what asset allocation model should you use, what do adjustments to that asset allocation model do to your financial plan, how do you set up an account, how do you fund the account, how do you place a trade. Now, this course sells all day at $500 per course, like $500 all day, okay? I have it discounted at 95% right now for you. Coupon code PRO96. Click on the QR code, coupon code PRO96. That course is yours for $23. Why is it $23? Because everyone can afford to get their financial house in order for $23. There is no one that can't do that. There is no one that shouldn't do that. That's why the course is priced where it's priced. Let me get that down right now. So let me talk with you. Here we go. Let me go back here. There we go. Let me talk with you about, hold on one second here. Okay. So let me talk with you about uh some real life client stories and things that really went wrong and how that could have all been prevented by simply educating themselves first. Most of these clients, and one of the saddest stories I have is a client that made this mistake. They were new to me and they came on and they just made the biggest mistake, one of the biggest financial mistakes I'd ever seen in my life. And that's real. That's real. I was working out in Henderson, Nevada. Henderson is outside Vegas. It's a Green Valley Ranch. It's a community that the people that kind of work in Vegas and around Vegas live in. And there's a Sun City retirement community there. It's a beautiful place. Henderson was a beautiful place. I'm not a monstrous fan of that particular desert because there's no wind there. I think that's the thing that messed me up the most. The sun wasn't the thing that messed me up the most. And even some people say the brown gets them. That didn't really bother me either. The fact of the matter was the wind. There was no wind. That's what bothered me the most. But anyway, that's neither here nor there. Outside of Henderson and Vegas, there are also some small towns, and in these small towns are hotels and burger joints and all the typical stuff that small towns have. And I had someone that I met that owned a couple of hotels. Basically, those hotels are used for overflow. So they're just if the conventions pack up Vegas, then they pack up Henderson, then they pack up Red Rock. People have to go elsewhere. So that overflow leads into these small towns. And I had met this couple that had a couple of hotels out there, and they had inherited or were inheriting as I met them $3.2 million, a significant amount of money they were inheriting, and they were inheriting like really quick. I can't remember how quick. It was within a couple of weeks when the money had showed up. So they had a parent pass away and they inherited this money. And an interesting fact about inheritance for those of you that may be giving money to someone, or those of you that are expecting money from someone, most inheritance is 80% of the inheritance is spent within the first 12 months, and over 90% is spent in a little over 18 months. Feel free to look that up. You'll find out that I am not lying to you. Inheritance is usually very quickly gotten and very quickly spent. And the main reason for that is people don't educate themselves on money. They think I have this money now. So I can tell you a misconception. Let me break away from the story and just tell you a misconception I hear all the time. One of the biggest misconceptions I hear all the time is if I just had more money, if I just had more money. Now, there are certain cases where I know that that is true. Okay. That's not that's not the rule, that's the exception, but there are cases where I know that is true. Most people, if they are given money, because they have lack of experience in dealing with money, they tend to spend it haphazardly on whatever with no plan, no nothing. And what happens is they not only spend the money, but they incur debt along the way, which is the worst possible combination you could ever do, because you think, hey, I'm going to invest it here. Hey, I'm going to invest it there. I'm going to invest it there. I'll put some money here. I'll put some money there. Well, I'll buy myself one toy. Next thing you know, all the money's gone and you've incurred debt, which brings me on to this story. And I think I just gave you a little heads up as to where I'm headed here. So this couple inherits this $3.2 million. Very, very quickly, they spent $1 million of it. I mean, so quickly, it's not even worth mentioning. 6 weeks. They bought this big giant RV. They bought these big sand rails. They bought some trailers, like enclosed trailers for the sand rails. And, very, very quickly, they spent $1 million. 15 months later, the money was effectively gone. When they met me, they had saved about 200,000 in IRAs, which wasn't terrible because they had a nice life. They weren't saving enough, obviously, but they had a nice life. So it's understandable that they wanted to have a couple of nice things. They wanted to spend a little money, but in 15 months, they had spent all of the inheritance that they had received. They bought a lot of land. They bought some real estate. This is in 2007. They bought a lot of land. They bought a lot of real estate. And by month 18, they had taken that original 200,000 they had in their IRA, and it had dwindled down to somewhere between 60 and 70,000. At which point I told them they needed to take that money out. There was no point in me having it any longer. There's no point in paying a fee on money you have to spend. It doesn't make sense. I kept trying to tell them that they had an opportunity to sell some of the land. They had an opportunity to sell some of the real estate, but it had already taken, they were little losses at that point. They had taken some small losses and they weren't willing to take it. They said, no, if you hold this for the long term, it's going to be worth X amount of dollars. But here's the thing. They had also incurred a little over $1 million in debt that they now had to pay on, which is why they were depleting their IRA accounts. Okay. So that's why. So I told them they had to go. They are the worst story that I have because I liked them so much and they were so nice. But what they did was they didn't educate themselves on anything. They got this money. And I can tell you that they didn't listen to me when it came to buying land and when it came to buying real estate. They were buying and they were incurring debt. And I every day was telling them not to do that. But as I told you, I didn't really have a long-standing relationship with them. I met them the way I met everybody back then, which was either cold calling or cold knocking, as I called it. So that could be residential doors, but that was a lot of times it was businesses. And that's how I met them, at their business. And as I told you, when I met them, they got to talking with me. We liked each other. They transferred that money over 2 weeks later. And I have to tell you, for the next year, I barely heard from them, except for when they were pulling money out to buy all this stuff. And I told them as they were doing this that, like, look, you have to stop. You have to stop. I pulled them in. I even built a financial plan just off of me saying this is kind of what it costs. This is kind of what this is, because I wanted to show them that what they were doing was an enormous mistake. But they were one of those people that they did run a business and they ran it successfully. So they're not dumb or anything. These were smart people. The problem was they always thought, it's easy to make money with money. But in order to make money, you need money, right? Now, I do agree that to make money, you're going to need some money. But if you don't understand where you're putting that money, you're just putting yourself at risk. Needless to say, they lost everything. I saw a couple years later that those hotels were sold, and I'm not really sure what happened. And I always felt way too bad to reach out. And that's a horror story, and that's a magnified horror story because of A, where it was. Vegas and the surrounding areas were hit harder than anywhere. So during that whole 2008, 2009 crisis, they were hit harder than anywhere. Those vacation spots were obliterated. I know because I was living in Henderson at the time. I left Henderson mid 2007 when I moved to Southern California, and it got obliterated. I would go back once a quarter. As I told you, I believe, even though I'm an investment manager, I never did asset allocation, right? I always did sector rotation, industry rotation, and I'm a long short guy. So I will go market neutral, right? I will add juice to the market. I never did that stuff, but I'm a firm believer in having a financial plan and looking at it once a quarter so you can look at it. So it can either provide you with confidence that you're doing the right things or warn you that you're doing the wrong things. Okay. So that's why I'm a big believer in it because I've watched it. I know how it works. Educating yourself will never ever do anything bad to you. Like it will only help you. And this is the beginning. This is step 1. This is without this nothing else works. Okay? So let me pull it up again. I want to put my Invest Like a Pro course up one more time here. I wish I could ask you all what you would like to hear about because I'd love to cover it. But I think what I am going to do is I'm going to talk to you a little bit about leverage coming up here. But first, let me tell you about the Invest Like a Pro course for anyone that is newly joining right now. The Invest Like a Pro course is 7.5 hours of video tutorials that I walk you through. Right, for 7.5 hours, you walk through. You learn the history of Wall Street. You get all the tools you'll ever need to set up a proper financial plan based on Monte Carlo simulation. Okay. You'll get all of that. Then from there, you'll learn what accounts are probably necessary for you. Do you need an IRA? Do you need a Roth IRA? I lay out the differences in those investment umbrellas, if you will. So I lay out the differences there. And then you go into learning about asset allocation and asset allocation models and which one might be best for you. Then you'll head back. You'll kind of play along with different models inside your own financial plan. From there, I show you how to set up an account for yourself at like a discount firm, maybe E-Trade or Ameritrade. I think most people know how to do that. But if you don't, I walk you through it, then how to place a trade, how to transfer funds from A to Z, from someone who doesn't understand finance at all to someone that has a heck of a good financial plan. Really the same financial plan that anyone at a major brokerage firm or at a major bank is going to build for you and charge you for. Uh, this course is traditionally $500. Click on the QR code now. The coupon code is PRO96. This course is 95% off right now at $23. Okay. $23 that course is right now. Why am I selling it so inexpensively? Is it because I need to sell some of these courses and get them off the shelf? No. I am selling these courses at $23 because I don't want anyone to have an excuse as to why they don't have a proper financial plan in place. All right. 7.5 hours of video tutorials, a 70-page workbook loaded with links to over 7.5 hours of videos, budgeting, financial planning, asset allocation. You will get more out of this course than you would a 4-year degree from a college on business finance. You will get more out of this course than that. How can I say that? Because my degree is in finance. I've worked in finance for 25 years. I know what you're getting. And I hope through the conversation, the storytelling that I'm doing right now, you're starting to see that what I'm telling you is accurate because you don't know me, right? You don't know me. So hopefully this is hitting home with some of you, and I really, truly hope it is. Let me pull this down. Let me pull that down as well. There we go. Just tuning in. When was this? I don't know when that was. I didn't have my chat up, so I don't know when that occurred. But in any case, someone's just tuning in now. The interesting thing about this, the chat on this Restream and these different platforms is that I can only chat with someone on Facebook, someone on Kick, or someone on YouTube. Outside of that, I can't really I can't really chat with anybody, which is a real shame. Okay, so financial planning. So some other mistakes. Let me see. So let me tell you this too. I want to give you a little background on myself and why I do what I do and why I believe in finance. To the degree that I do believe in it. Why is it that I believe that being financially sound is so important? So a little background on me is that I grew up definitely poor, without a doubt. I'm not going to say modest means or play it down. I was poor, very poor. Um, that's how I grew up. And so I know what it's like not to have money or choices or, food in the fridge sometimes. So I'm well aware of that dynamic. Is that why I think it's so essential for you to be financially literate? I mean, that's part of it because one of the things that will get you out of that cycle is knowledge, is an understanding. So, yes, I suppose that's part of it. But as I came up and I was in high school, I became a wrestler. And what I learned about in wrestling was discipline. I would tell you that the main thing you learn about in wrestling is disciplined approaches. Staying disciplined, whether something hurts, whether something's incredibly fun, right? So you're really excited. It doesn't matter. You can't celebrate on the mat, or your coach will knock your head off if you embarrass your opponent. So you learn how to be humble. You don't get overexcited when you win. You also don't get depressed when you lose. It's like back to the drawing boards. How do we figure this out? And because of this background, because of this basis, and I grew up in Pennsylvania, which is a very difficult wrestling state, right? Because of this background in wrestling, this is where finance really came into play. Because as I began to learn about finance through the first company that I had, the first company that I personally had was a landscaping company. And what I started to learn about in the landscaping company about money and finance and getting clients and all these different things was that money required a hell of a lot of discipline. You had to stay really disciplined in order for money to work for you and not against you. Because otherwise, money will work against you. Money will hurt if you don't understand money. You don't understand the reasons that you have it and the reasons that you use it, which should be freedom of choice. I mean, really, it's freedom and really it's choices. That's the real benefit of wealth. The real benefit of wealth is freedom of just choice in everything that you do. What type of foods you eat, what kind of health care you get, what kind of mental health care you get if anything should go wrong up there, right? Taking care of your physical health, who can train you, who can help you become a better person. Because the fact of the matter is, most good things cost a lot of money. Now, why do they cost a lot of money? Is it because everybody is so greedy out there? No, not at all. Listen, I say it all the time. The epitome of something great is art. So no matter what it is. So you love cars, right? I don't I love cars. I couldn't tell you what is the best car in the world. I couldn't tell you that. But I can tell you this. Some of the best cars in the world are the Italian made Ferrari and the German made Porsche. That I can tell you. Those are some of the best cars made in the world. Now, why is it that they cost so much? Well, they cost so much because the person that designed these things did so meticulously, and they're so handcrafted, and they're so mechanically sound, and they're so aerodynamically accurate, and their suspension is so on point. They're almost art. They're almost art. So that's expensive to buy art. And why is it expensive to buy art? Because usually art, by the time it is art. So for someone to get so good at something, to master something to such a degree that it's art, they have put tens of thousands, if not hundreds of thousands of hours into learning this knowledge, into attaining this knowledge. And then for them to give it to you, it's not going to come to you cheap. To get that art, it's going to cost you something. And usually it's significant, right? That's why if you go to a restaurant and the food's amazing, and it's a Michelin star chef, you're not paying the same price as Chili's. I'm not knocking Chili's, baby. I'm just saying you're not paying the same price because you're eating art. I think you follow along with what I'm saying here. So everything good in life costs a lot because the people that are doing it have put their soul into it. And that's what truly makes it great. So if you want to get the best health care, You can't go into the standard hospital that just requires the degrees and all the stuff, and then the guy goes in and he makes his living. I'm not saying that guy's doing a bad thing. He's doing a great service. But if you want the best healthcare and you want to find the best guy, you're going to pay the most money. And everything in life runs that way. From I've seen it. Okay. You just say you want to live somewhere nice. Guess what? It costs more, right? It's not just about having flashy crap. And I believe that. You have a mental health problem, you have some sort of a breakdown, something goes wrong in your life that it breaks you. When you have money, you have protection because then you can get the necessary help. Now, some would argue that that could be a bad thing too, because you don't need any help if you have all that money. Yeah, you just go on doing what you want to do, and you're crazy, and you get away with it. But I'm not trying to. I'm just talking about if you need downtime, if you need a year or two to like really downtime, where I don't have to worry about money, I don't have to worry about bills or the cost of a house or anything. Like money will help you do that, right? Like I'm a big believer in if you could just eliminate that one giant cost in everyone's life, which is a home. If you could eliminate that cost, the world would change because people would begin to do what they want to do. And guess what happens when people do what they want to do? When people do what they want to do, they're passionate. It becomes art, and you can live in a world of art instead of a world of business. Now, don't take this next statement the wrong way, but if the epitome of excellence is art in whatever it is that you do, then the opposite of that would be business, just making it a business, right? Like, let me explain to you what I mean. Usually an artist, and that's you like fashion is a great way to do this. So I'll like this is a joke about fashion. I'm just kidding, but it'll kind of put something into your mind here. It reminds me of like Zoolander. There's a part where like derelict, right? It was all homeless people. They looked shabby. They had like broken down carts. Like it was one of the greatest scenes ever. Like derelict, right? And how that, but there's it's funny, but also it does translate into real life. So what derelict really meant was kind of that like hippie chic hang off the body kind of clothes, right? That's what that would have translated to. So that's the art, that's the translation. And then by the time it hits Sears, you're just putting some holes in the jeans and wearing big sweaters or like whatever, like TJ Maxx. I don't even know like exactly where you would go get that stuff, but whenever it trickles itself down, it basically turns into garbage. Just like food, you have this French pastry chef or like this guy that studied French pastries. You really think a Twinkie started as a Twinkie? No, it started as something amazing, and then it got down to the level of business, right? And it sucks now. Like, no offense, it does. And so that's where my passion for wealth and finance and health comes from. Because the other thing I learned in wrestling was that if you're not good up here, if this isn't right, nothing outside can be right. Not your relationships, not your business, nothing. Nothing's going to be right if you're not right up here. And guess what one of the biggest stressors in the modern era is? Guess what one of the biggest stressors in the modern era is? It's money. It's money probably for a couple of reasons. We're going through a weird transition now. I don't know if it's good and I don't know if it's bad. But what I can tell you is the day of having this full-time job and staying there for 40 years and getting was it a watch? I think I used to get a watch. You would get like a watch and a pension, and then you hit the bricks and you were out of there and you worked there your whole life and it supported your family. Those days are gone. All right. Right now, it seems that we're in this new gig mentality, which creates its own stress because there's just too much uncertainty. So before, I think there was so much certainty that people were kind of miserable. They felt like, oh my God, like this is my life. This is a nightmare. I'm going to do this till I die. Right. Well, today, if you march forward to today, I think perhaps it's gone too much the other way. I could be wrong, but it's gone too much the other way where there's so much uncertainty now that nobody can relax. Nobody can feel comfortable. So what does that mean to someone like me who's in finance? Well, first thing it means is I will offer things like this, my Invest Like a Pro course at a 95% discount. The thing is typically $500. Right now it's $23 until midnight on Tuesday or until I sell 1,000 of them. I'm not going to go into the whole pitch. I'm just pulling it up. What that means to me is that I try to do things to give back to people that might not be in the best financial situation, that might be struggling up here, because mental stress, so your physical stressors are, they're pretty easy to recognize. I think most people know, when they're having a physical stressor, when they need, like, if you have an injury, I mean, right? Like, so you're someone who, I don't know, like, you mountain bike or you do CrossFit. If you hurt something, you know it. When you hurt your mind, a lot of times you don't know it so well, and you kind of keep hurting it. You don't stop. You don't stop and repair the damage. You just kind of keep trucking forward. And because it's not as obvious, when you hurt a muscle, it's pretty obvious. Well, I can tell you that financial stress, when it hurts you emotionally, it hurts your body. What is the leading cause of heart attacks? Right? What is the leading cause of strokes? What is the leading cause of illness? Stress and inflammation. What's inflammation caused by? Increased cortisol levels. What's increased cortisol levels caused by? Stress. So if one of the number one stressors in the world is financial stability, is financial health, if I can be someone that can help someone else get financially healthy, well, great. I want to be a part of that. And I'm passionate about it because I have seen the difference in a financial healthy life and a financially unhealthy life looks like. And believe me, you don't want that. You don't want that. So for all you young people listening out there, I'm going to get into the time value of money after I tell one story. So time value of money simply being like, why is it so important to start investing and being financially sound early? Like, what is the impact of starting later? I'm gonna walk you through that in a few minutes as I talk about the rule of 72, which is really the time value of money, how that affects your investments and how that'll affect your life, and why, if you're younger, starting now, even with $50 a month, is critical to your financial success. It'll change your life. All right. And I'll walk you through how that happens. But give me a minute. I'm gonna circle back to that. Right now, what I'd like to talk about is what we were talking about, which is the stresses that finance causes. And I want this to really hit home with all of you, because when you're financially unhealthy, your relationships suffer, your marriage suffers. You tend to work jobs you don't like, or jobs that you hope you never have to work again, jobs you don't like going to. You're not inspired on a daily basis, which causes depression. Also, when you're financially unhealthy, you're constantly anxious about money. And let me tell you something, money is not something you want to be constantly anxious about. It's painful day in and day out. It's painful. Okay. All of these things wear on your mental. Everyone, I'm sure, listening right now knows that if something wears on your mental, it's going to wear on your physical real soon. It's all a matter of time before your physical deterioration begins. And that might just start at some bad eating habits that get you a little heavier than you're used to being, which starts to cause some different pains, which might lead to you sitting around a little bit. You're fighting with the wife more. You're not playing with the kids as much. I mean, listen, your mental deterioration will add to your physical deterioration. And let me tell you something, I am a big believer in your health and your wealth. If you can control those two areas of your life, you'll have a happier life. Life isn't all, as I was just explaining to you, this isn't all about being a baller and flying jets. This is about having choice and enjoying the art of the world, not the Twinkie business of the world. And we're all in those positions. I've been in those positions plenty as an adult, as a young person, in the middle, you name it. And there's nothing wrong with it. It happens. Certainly nothing to feel bad about. But it's definitely, if you can prevent it, if you can help it, this is a great idea. I'm just saying. And at a discount of 95%, getting a course that is 7 hours of video tutorials, 70 pages of workbook that will walk you through everything you need to set up a financial plan, learn about asset allocation, set up a model, choose your account, fund your account, etc., etc. You can't beat it. All right. So I hope that kind of hits home with you on why I'm so passionate about it. I'm so passionate about it because I grew up and I grew up in a place and time of nothing, really truly nothing, even like lack of food in the fridge. And Know how hard it is to climb out of that, by the way. You're dealing with high interest credit cards. You're dealing with a lack of credit cards. You're dealing with a lack of money. I've been on my own since I was 17 years old. It's not an easy thing to do. It's not easy. But it's funny because, when I was a senior in high school, I lived on my own. I had to work full time to pay rent while I was a senior in high school. So I know what a lack of money will do to your life. It makes it harder, much harder. So I'm passionate about trying to help people get the best possible start because I didn't give myself the best possible start. I made good money. I ran a landscaping business. I did really well. I was making six figures when I was, 18, 19 years old. I didn't invest it properly. I didn't save it properly. I made every mistake a person can make when they're young. I did. And I want to help other people not do that. And if you're in your 40s, this next conversation is for you too. I want you to listen. If you're young or if you think you're too old and you haven't saved enough and you don't have enough time and this isn't going to work for you. You're not going to be successful here because you didn't save soon enough. You need to figure out a way to fast track your success. You want to figure out a way to skip some steps. And that's probably another one of the biggest mistakes I saw as a financial advisor is that people think they're going to skip steps now that they didn't save appropriately, they didn't plan appropriately, and now they're going to skip steps mainly because they think it's too late. So I'm going to demonstrate to you here in a minute that it's not too late. And I'm going to show you young people out there, like, listen to me, dude. Start now. Everyone's going to tell you that, but I'm going to give you the numbers. I'm going to tell you why you start now. Okay. So let's talk about it. So we're going to start first with, with someone who's middle-aged. Maybe you have a couple of kids, a wife, you're 45 years old. Let's start with you. So you come in, you get this course, right? It's $23. Literally means nothing to you, $23. You skip Starbucks this weekend. It means nothing to you. But what it's going to give you is going to blow your mind. So you go into it and you set up this financial plan and you do it right? You take a couple of weeks, you get this financial plan set up, you learn about asset allocation. By the way, you can learn the way I've laid out. I'm calling it a course. It's really a system for your financial success. That system I could teach to a sixth grader in today's sixth grader in 2 hours, maybe less. It's that easy. Actually, definitely less. They're very computer illiterate. It's probably less than 2 hours, but you jump in and you start learning. And so you set up this plan. Okay, I'm making $180,000 a year. Right now, I only have 100,000. I'm 45 years old. I'm not really able to save right now. The kids are in private school. Inflation's insane. My mortgage was adjustable. Why'd I do that? God damn, why'd I do that? Well, you did it. Now you're dealing with it. And then you go in and you learn about asset allocation. You set up an asset allocation model, and it's a growth model. And it says that model averages you, 10% on your investments per year. So, you'll average 10%. And then you say to yourself, okay, so if I have 10%, if I work for 30 years, so if I work till I'm 75, which look, let's just face it, the way the world's set up now, there's not going to be retirement like there was in the past. I think everybody's going to work a little bit. And I have to tell you, I think that's a good idea. I can tell you the story of two separate clients that they went to retire and they had pensions and they were going to sit on their butts. Neither one of them saw their actual retirement. They passed away first. So I don't know that planning on sitting on your butt in retirement is a great idea anyway. But so he plans out 75, middle-aged guy, 75, 180,000 a year. I have $100,000 adjustable rate mortgage. I'm an idiot. So my cost has gone up and I have these credit card bills, like private school. He lays it out and he says, okay, well, so what? Okay, I make 10% a year on my assets. What will I have 30 years from now? So let me explain to you what you'll have 30 years from now. There's this rule. It's called the rule of 72. What the rule of 72 means is it's really simple. You just take the number 72 and then you divide by your rate of return. So in this case, it's 10%. So every 7.2 years, this guy's money is going to double. So if he's going to work for 30 years, he basically has the opportunity for his money to double 4 times. So let's just say that he never saves again, which that's not going to happen. And you're going to include that when you're setting up this financial plan that you will save again. But let's just say he never saves again. So basically right now, if he does 10% a year in his investments, he's going to have some crypto, some stocks, some bonds, some metals, some commodities, so on and so forth. He averages 10%. He has 100,000 right now. So his first time is 200,000, 400,000, 800,000, 1.6 million. This guy has $1.6 million by the time he's 75 if he never adds another nickel to his investment portfolio and he makes 10% a year. So it's not as devastating as he thinks because if he follows proper withdrawal rules, so if he's 75 years old, he wants his money to last 20 years and he doesn't even invest it, he can withdraw 5% a year for 20 years. What's 5% of 1.6 million? It's like what, 80 grand a year? $80,000 a year. And this guy has that for the next 20 years guaranteed if he doesn't even invest it. And he's never added a nickel to the 100,000 that he saved now. This guy's far from in a desperate situation, right? Well, let's just say that after doing this financial plan, he realizes like that I know what I'm talking about. So he decides he's going to take my next course, which is it's actually really the next piece of a system. I don't want to call this courses. It's a system that is designed to make you successful. And what that system, the next part of that system, is designed to show you how to identify areas of weakness. That means when prices are high, and areas of strength. That means when prices are low. Sounds counterintuitive, but it's accurate, right? So areas of weakness, high prices, areas of strength, low prices. He learns how to identify those, which gives him the opportunity to avoid most major bear markets, definitely not get hit by the big ones. And it also allows him to confidently invest when he sees a market begin to rise. So his 10%, he's now averaging about 20% a year, right? How quickly could he have done this? I mean, he could go through the financial planning course in a couple of weeks. He can go through the next course in not even a month. He could probably go through that in the next few weeks, 3 to 4 weeks. And he probably would start doing some one-on-one coaching with me or become part of the mentorship program or become a subscriber to my weekly market updates and information that I send out. So he could become a monthly subscriber to my weekly as well. But he's going to do one of those things, right? So, and in those, by the way, when I do this stuff, when I work with people one-on-one, I help them. I help them further. They take their investment plan further. Obviously, that's what I'm here for. For now, we're just talking about the financial planning. So this guy learned how to identify major bear markets, and he learned how to identify when good times to buy are. And so what happens is he takes his average of a 10% return and he moves it to 20. Right now, if you're online right now, particularly like TikTok or social media, 20% a year is garbage. Like I do that in a month. I'm about to prove to you that no one does that in a month, by the way. And what does 20% really do for you? Well, let's talk about it. So if at 10%, your money is flipping every 7 years, that means that your money is flipping now every 3.5 years. So every 3.5 years, your money is doubling. So if he has that same 30 years to go, he doesn't have 4 flips, he has 8. So let's talk about what that did, like what happens now. So here he is. He has 100,000, right? His first flip, 200, 400, 800, 1.6. That's his 10% return, 1.6. 3.2, 6.4, 12.8, $25.6 million. Does this guy have any reason to panic and try to cut corners, add leverage, find options, go to futures? Does that guy have any reason to do that? No, none. Because everything I just named contains infinitely more risk than simply having an investment plan that helps you. So you're running some sort of a sector rotation or asset allocation along with your identifying areas of strength and identifying areas of weakness. You're getting out of the way, you're getting in the way. That is not a complex model. And now this guy knows, he goes, wow, my worst case scenario is like 1.6. And even if I catch the middle, like let's just say he caught the middle, right? So he got 6 flips, not 8. He didn't do 20%. He didn't do 10. He did 15. Like he managed to do 15. Well, he's at 1.6 here. He's at 3.2 here. $6.4 million. He's 75 years old. Does he have anything to panic about? Should he be listening to some 22-year-old kid showing you some chart that God knows where he got that from? Why he's talking about futures and derivatives and all these things that there's no possible way he can understand. And he certainly can't understand the gravity of loss when it comes to derivatives, when it comes to leverage, but I sure can. Oh, I sure can. No. So there's a reason right there as to why if this guy has a financial plan, he's 45 years old, all he saved is $100,000. And guess what? He's just fine. If he takes his financial education to Just setting up a proper financial plan, setting up a proper asset allocation model, and averaging 10% per year, never adding any more money to that original $100,000. He has $1.6 million. This is not a depressing thought. Now let me talk to you young people out there. So let's talk about what happens with young people. So let's just say this. Let's say that you are let's say that you're, I don't know, you're graduating college or you're in college, you're in your like final year of college, right? You're 21 years old. You have $6,000. You know what? Yeah, $6,000. You have a 6,000. Now let's say 10. Let's say $10,000 investment. You're 21 years old right now. Okay, now I'm going to show you the benefit of starting now. You have $10,000. You're 21 years old. You go through and you do the same thing as that 45-year-old does right now. You do the exact same thing. Okay. So you go in, you set up your plan, you learn your asset allocation. You too come up with about 10%. You know the rule of 72. So every 7 years, your money's going to flip. You pick the same age as him. You say 75, right? So how far away from 75 is 21? Anyone? 54. So what's 7 into 54? We're going to pretend that it's 8. We're going to pretend it's 56. So you have 8 flips on your 10 grand. Doing nothing, setting up a proper financial plan, proper asset allocation. You have it rebalancing every 6 months, right? This isn't just like I put the money there and I go away. You're going to rebalance every 6 months. What happens to your $10,000? Well, you have 8 flips, right? So your 10,000 becomes 20,000, then 40,000, then 80,000, then 160,000, then 320,000, 640,000. 1.28 million. We're going to call it 1.3 million. You have 2.6 million. You now have $5.2 million. You have $5.2 million from 10 grand doing nothing fancy, nothing at all. Now, let's just say that you decide, like the gentleman before you, that you're going to advance your knowledge, not even any further than he did. And let me tell you, learning how to identify major bear markets or areas of areas in which you would buy are not difficult. This is not difficult. This is not something that can't be done. Contrary to what you're told on TV, you absolutely can do this. So let's say there's a reason that Warren Buffett right now is holding more cash than he's ever held in the history of Berkshire Hathaway. And I assure you, it's because at this high price, he sees the same weakness that I see. He's going to avoid it until the market dumps. And once it dumps, if it's a year from now, fine. If it's 2 years from now, fine. If it's 3 months from now, that's fine also. Because he's going to take all that cash. He's going to buy all those depreciated assets up. And then he's going to take them to the moon again. Just like I'm going to do. Do you think I'm invested right now? No. Why would I be? We're in an area of weakness. I'm not short either, by the way. So this college student, right? 21 years old, does the same thing as the gentleman or the female that's 45. It doesn't matter. Listen to me, everybody. Gender doesn't matter. I don't care. I'm just telling a story. It makes no difference if it's a man or a woman to me, or something in between. That doesn't matter to me either. Although I don't know that there is anything in between a man and a woman. You're a man or you're a woman, I suppose. But I digress. I'm like going off task here. So this person does the same thing. So now they know they do 20% a year, right? So they had 8 flips before. Now they have 16. All right. So what was the number I said? 5.6? Was it 5.6? Then they have 8 more. So then it's so funny. So let's just call it 11, right? Then we'll call it 22. Then we'll call it 44. Then we'll call it 88. Then we'll call it, what is it? Jesus, 88, 160, 170. 176. We're going to call it 175 so it's easier. 350, 700, $1.4 billion from $10,000. Now, what I want you to do is I want you to take the information I just shared with you, and I want you to use it in 2 ways. One, that is the reality of what would happen at $10,000 over 30 years if you were simply averaging 20% per year. You would have $1.4 billion by the time you were 75. I want you to apply that in 2 areas. One, look at the amazing opportunity you have in front of you right now. Like, it's an amazing thing to have that kind of time in front of you and that kind of ability in front of you. I want you to use it for that. And then there's something else I want you to use it for. I want you to realize that these people online that are telling you they're doing 50% a month or they're doing 20% a month, does that sound right? Think there's a bunch of billionaires on TikTok? Do you? Because the fact of the matter is, if you were doing 72% a month, 72% a month in an investment account, that means your money doubles every month. So even if you start, these guys, they're all ballers. I see them. And I'm not telling you can't day trade, by the way. I'm not saying that to you at all. And I'm not telling you there's not very, very responsible ways to use options and futures. There are, and I do. And you should too. But that's not where you're at yet. What we're talking about today is financial planning. All right. We're going to talk about options and futures, and I have some educational places I can send you. I don't particularly educate on derivatives, even though I know how to use futures and do use them. Options, I'm a little less savvy, but I have guys that are beyond savvy in those products, and they do know how to use them, and they do extremely well. Um, where was I? Oh, so if this guy's doing 72% a month, that means every month he's flipping his money. So if this baller even had 25 grand and he lived through 1 year, just 1 year, it's 72%. He makes 72% per month for 1 year. He has 12 flips, right? So 25, 50, 100, 200, 400, 800, 1.6, 3.2, 6.4, 12.8, 25.6. That kid, 25.6. Hold on. I forgot. 51.2, 102.4. That kid has $102.4 million in 1 year from 25 grand. Does that sound right to you? No. No. Nope. Even if that kid was doing 35% per year and he only had 6 flips, he would have 50, 100, 200, 400, 800, $1.6 million. 35% a month. Does that sound right to you? Right. It's not right. And that's not the way it's done. And so you can use this knowledge. The reason I say I'm an educator is because I am. I want to educate you so that you can do this for yourself, or I have to tell you that I do this for others as well. So I also run a service where I do this for you. I'm still a financial advisor. I just don't manage the assets for a percentage any longer, right? But I'll get you a financial plan set up. I will help you set up your investments. I will show you how to do it. Anyone above 6th grade can learn how to do it in about, like, really, if I'm just showing you asset allocation in an hour, in 30 minutes, I can show you where a financial advisor would put you. We can put you there, set you up on a 6-month plan to rebalance. If there's any of you out there that are listening and you're more interested in the investment side, I'm not going to get into that conversation a lot, but I am offering the portion of my of the investing where I teach you how to optimize your investments. It is a 95% off today. I'm going to take a break here for about 30 minutes, and I'm going to be back, and I'm going to talk primarily about investments when I come back. Coupon code. There we go. I'm going to talk primarily about investments when I come back. So this is my intermediate trading, investing, and forecasting course. If you click on the QR code there and you use the coupon code intermediate 95, that'll give you 95% off. It takes that course down to $100. You will learn how to use price, volume, gaps to identify weakness in markets at high prices, strength in markets at low prices. And you'll have a very good idea of when to buy and when to sell and how to avoid major bear markets. I am making that 95% off again. That is only until Tuesday at midnight or when I sell 1,000 of them, one or the other. I don't know which it's going to be, but that is a 4.5-hour course, 4.5 hours of video tutorial with me. It is, I forget how many pages are in the workbook, but it has a workbook that walks you through step by step as well with workable links via PDF. That course is only, it's $100. Again, it's only until tomorrow night at midnight until I sell 1,000 of those. I'm going to take a quick break here for about 30 minutes, and then I am going to jump back on, and I'm going to talk more about the investment side. So I want to talk more about, I talked to you about guys that are very good with their derivatives, and they're great teachers. You learn the flows of the market. The What you need to know if you're going to be in there day trading every day is the undercurrent of the market. Who is making the market move via derivatives, and how are they doing that, right? That's what you need to know. But we'll talk a bit about this as well. My intermediate trading, investing, and forecasting course, which focuses on just identifying when large institutions are either buying or selling and making sure you are on the same side of the market that the big institutions that run the market are on. All right. Thank you all so much for joining me. I will be back in about 30 minutes, and I'm going to go live again.